This is the financial literacy review for chapters 8, 9, 10, and 11. There are 50 questions total, some true and false, some mostly multiple choice, just to let you know. And hopefully you'll pull out a piece of paper, take some notes. I will review every single question. And I promise you that if you focus yourself, pay attention to the review, combine it with a little bit of study in the textbook, mostly over the vocabulary words, you will do fine on the test. Okay? All right. As you'll remember, those 4 chapters that we dealt with have everything to do with investments of various kinds. Okay? We talked mostly about the stock market, the bond market, mutual funds, real estate, and some alternative investments. That's what it's about. Okay. All right. Tell me about when you make an investment and you increase your wealth because of the investment, what do we call that? We call it a what?
Capital gain.
A capital gain. That's what we call it. We don't call it a profit. Profit is what happens in a business if their revenue exceeds their expenses. Capital gain is what we call it when you make money on an investment. Okay? Now there are 2 types of capital gains. Anyone remember what they're called? Nope. Sounds good, but capital gains are broken down into short-term and long-term capital gains. Short-term capital gains are gains you receive in a year or less. If you make an investment, sell the investment, make money in less than a year, it's called a short-term capital gain. If it's over a year, it's called a long-term capital gain. And it can be very significant because it gets taxed rather differently, substantially differently. A short-term capital gain is taxed as ordinary income. That's important for you to know. A long-term capital gain is taxed at a reduced rate. The government is encouraging people to make long-term investments, not short-term. Let's see. Yes?
Long-term is taxed what?
At reduced rates. And it gets a little complicated, so it doesn't matter. That gives you enough information. Yeah. What are the most speculative investments we've discussed recently? If you had to put the 5 or 6 investments we talked about in a scale of very safe to very risky, which ones would be the riskiest? Aaron? Collectibles. Yeah. Collectibles, commodities, gold, silver, we talked about that. We talked about gems. All of those kinds of investments are very speculative. And as I mentioned to you, do not expect to become wealthy based on your collections. Okay? Also, option trading and commodities. Now, we didn't talk about some of those very much, but those are not particularly safe. On the safe side, we have got savings accounts, treasury bills, investments in any treasury notes from the government. We have safe bonds. Bonds are relatively safe. And then sort of in the medium range, we have traditional stock market investments and real estate investments. Okay? Now, in the stock market and in the real estate, you can get pretty speculative. You can buy high-risk stuff. But traditionally, stock market and real estate are considered medium risk. Okay? Let's see. You're selling a piece of real estate. What is your primary concern about the potential buyer? What would your primary concern be with the potential buyer? What do you think? Do you care really how he's going to use the property? Not really, not once you've sold it and moved away or something, you don't really care. But your primary concern about the buyer is, can he qualify for the loan? The vast majority of real estate, 99% of real estate, is sold using mortgages, using a loan. Most people don't have the cash. You know, interestingly, the only kind of property that is sold a lot for all cash is homes over $3 million. Very, very wealthy people who buy $10 million mansions, they many times will pay cash. But the vast majority of people never pay cash for a house because they never have that kind of cash to buy a house. So they're always using mortgages. So if I'm selling my house and Dustin comes to my house to look at it, my concern really is whether or not he can qualify to get a loan. That would be my big concern. Okay? Let me say, there are two reasons to make an investment. What are they? Growth and income. Growth or income might be a better way to say it. Okay? What's a growth company? What is in the stock market when I say that is a growth company? Only people that want to grow their investment will invest in that company. What is the distinguishing characteristic of that company?
Manages your investments.
They what?
They manage your investments.
No.
They don't pay dividends?
Yes, they do not pay dividends. Remember, if you buy a stock in a company like Apple, Apple yesterday is at an all-time high. Unbelievable how Apple has gone up, and a lot of people are saying it's going to continue. We'll see. They're bringing out the new iPad tomorrow. It'll be interesting to see how that affects the marketplace. But Apple is a growth company. It pays no dividend. Nobody will invest in Apple if they are seeking income from that investment. Okay? Income stocks pay dividends. Growth stocks do not. Okay? Good. Let's see. Would you invest in gold if you were looking for a steady income? No, of course not. Gold does not produce income. What kind of investments would produce a steady income?
Oil.
Maybe, although that would be, right, I know I've talked about that a little bit, so it feels like that's true. But generally, that's considered a speculative income. That's a high-risk investment. I would not recommend that generally. The kinds of investments that produce a regular steady income are, come on, what are they? Bonds. Bonds is definitely an income-related steady income. So is dividend-paying stock. So are savings accounts. Okay, those kinds of investments. Okay, let's see. If you'll remember in one of the chapters it talks about risk to your investments, and it listed like 6 different kinds of risk. Economic risk, inflation risk, all that kind of stuff. What would happen if you bought a stock in a company and that stock became worthless? What would that mean? What would that tell you? Other than you're a bad stock investor. What does that say about the company? Well, if your stock becomes worthless, what has happened? What?
It's out of business?
Yes, the company has actually gone out of business. That risk is called, anybody remember what that risk is called? That's the risk of business failure. Business failure would cause your stock in that company to become worthless. Okay? Name 5 precious metals. Gold.
Rhodium.
Rhodium.
Palladium.
What?
Palladium.
Platinum. Palladium.
Palladium.
That's the one you're going for. And silver, right? Gold, silver. Those are the platinum, palladium, and rhodium are the ones we've talked about. What's palladium used for? Anyone know? It's used in cars. I believe it's in catalytic converters. They use them in cars. So each one of those metals has industrial use and value because of its industrial use. Okay, intrinsic, what we call intrinsic value. Well, here we go. Here's where we get a little tricky. Anybody remember what a Series 1 bond is? Series 1 bonds are issued by the government and they are indexed for inflation. Series 1 bonds will increase their interest rate if inflation goes up. Just have to remember that, that's all.
What are they called?
Series 1 bonds. I thought I just said what they were.
Yes.
Maybe you want to sit closer so you listen better, maybe.
Just only one seat closed.
All right. Series 1 bonds are government bonds indexed for inflation. They adjust their interest rate based on inflation. Okay? How do you invest indirectly in real estate? What are the options to indirectly invest in real estate?
Mutual fund?
Mutual funds. Some mutual funds are very specific. You can buy real estate mutual funds. All they do is invest in real estate companies. That's true. You can invest in stock of real estate companies. You can invest in syndicates. Yes.
REITs.
REITs, real estate investment trusts. You can invest. There's a number of different ways to do it, okay? Syndicates are not limited liability companies. I'm telling you that for a very specific reason. They are not limited liability companies. Syndicates are partnerships, not limited liability companies. Okay? Let's see. What's an index mutual fund? An index mutual fund is one that mirrors one of the indexes, like the Dow. An index is like an average, S&P 500. You can buy a mutual fund that directly correlates to the S&P 500. So if the S&P 500 goes up 6%, so does your mutual fund. They buy exactly what the index is. That's called an index fund. Some people absolutely swear by index funds. They are not actively managed. Nobody's making decisions about what stock to buy. If the S&P 500 changes one of the companies in the 500 companies, then that mutual fund changes, and there's nobody making any other decisions. Index funds have done very well. They really have over the last 40 years when they were created. So that's an index fund. Index funds are characterized by very low management fees. That's because they're not making any management decisions. A computer can manage an index fund because all it's doing is doing whatever the Dow does or whatever the S&P does. That make sense? Nobody's making any analysis, decisions, type things. Okay. What do we call a mutual fund that only invests in oil companies or only invests in pharmaceutical companies or only invests in real estate companies? What do we call that kind of mutual fund? That's called a sector fund. A sector. There are 56 or 76 sectors in the stock market, different industries that you can invest in. Okay? How does the government raise money to build a school? What?
Raises taxes?
Nope. Not usually. Yeah.
Issue bonds.
What? All right. Yeah, they issue what we call municipal bonds. Municipal bonds are bonds issued by local governments. A city, Lehigh City would be a municipal bond. So would an Alpine School District bond. Municipal bonds, okay? And one of the features of municipal bonds is that they are tax exempt. They offer you a bonus if you buy into a municipal bond. Your interest is not taxable. Okay. When you buy stock, if I went on the computer right now and bought 100 shares of Microsoft, when would I have to pay for that? Anybody remember from the book? I have to, okay, here's how it works. I have money in my account. I have to have money in my account in order to buy it. But the transaction actually takes 48 hours for them to actually pull the money out of your account. They have up to 48 hours to clear the books after a transaction, okay? 2 days. Let's see. What is a convertible bond?
Bond that can be converted into stock.
Bond that can be converted into company stock is convertible bond, as opposed to a mortgage bond. A mortgage bond is a bond that is secured by the real estate of the company, by the buildings that they own. Okay? How do money managers and financial planners make money? That's one way. There are three ways they make money. Okay? They either get paid straight commission on what they buy for you, or they get paid straight hourly fees. It's a fee only. They call that a fee only guy. He charges $80 an hour to help you manage your money. And then we have a group that's called a fee offset planners. Fee offset planners get a small fee and they get a small commission. So it all depends on how they operate. Which one's better? I don't know. I'll tell you who the better one is, the one who makes you the most money. Good luck finding those. I don't know. They're hard to find sometimes. All right. Now, we've also talked about the stock market being broken into segments based on the size of the company. Anybody remember what that's all about? Well, how do we break the market? Now, remember, we have the biggest companies like Apple and like IBM and like General Electric. They are called what?
Blue chip.
Blue chip companies are also called large cap company, large capitalization. That means they're worth a lot. They're worth over 50 billion or whatever. Okay? And then we have medium cap companies. And then we have, who can guess what the last section is? We have large cap, medium cap, and small cap companies. Small cap companies are the smallest ones. Which ones are the safest investments?
Large.
The large cap. Walmart, Target, Coca-Cola. These are companies that have been around a long time and they are not leaving. They are not going away. Small cap companies can be a little riskier. They are less conservative. As I mentioned, you can invest in the stock market very safely or you can be very risky, depending on what kind of stocks you pick. So small cap companies are more aggressive. Now, over the last 100 years, they have produced a better return for investors. They make more money, but they're more volatile. They go down faster and they go up faster. And it makes sense if you think about it. A small company like In-N-Out Burger, they can double in size in 2 years. McDonald's can't double in size. They just can't do it because there's 35,000 McDonald's. They can't go to 70,000 McDonald's in a couple of years. But In-N-Out Burger can go from 250 stores to 500 stores. They can do that. And they could double in size. So small cap companies are for more aggressive investors, not conservative investors. Okay. All right, let's move on. Tell me the rating service, the two major rating services for bonds.
The AA, BB system.
What are the companies that give them the rating? Moody's and S&P, Standard & Poor's. The Standard & Poor's and Moody's are two of the rating services that rate bonds. And what's the highest rating they provide or give to either a company or a government bond? What is it? AAA, AAA. Okay. The second highest rating is AA. Okay. So it goes AAA, then AA, then A, then BBB, then BB, and then B, and it goes on down from there. And remember, anything up above B is an investment grade bond, meaning suitable for investment. Anything below a B, you're getting very speculative and you get into what we call junk bonds. Now, you can make a lot of money in junk bonds, but there is some more risk involved, okay? Let's see. What affects the rate of return you receive on a bond? What causes your interest to go up or down? Think about it for a second. You can get this. We've talked enough about this. What's the difference between a 2% bond and a 3% bond?
1%.
Thank you very much. What is it?
The economy,
No, not the economy. It's,
safety of the company.
thank you, it's the risk involved. Investors will always require a higher rate of return if the risk goes up. So some companies are riskier than others, and so they have to pay a higher rate of return to attract investors. There's one other reason that causes the interest rate to change, and that would be liquidity. So a short-term bond, or for example, let's use this term. What is the shortest term treasury instrument called? A treasury bill. How long is those? Under a year is a treasury bill. From 1 year to 10 years is called a treasury note. Anything over 10 years is called a treasury bond. Okay, so we've got treasury bills, treasury notes, and treasury bonds. Which one pays the lowest interest?
Bonds.
Which one?
Bonds.
Nope. Bill. The shortest one pays the shortest interest. That's because if I take my money and I put it away for 10 years, I demand a higher rate of return because I'm giving up liquidity. Does that make sense? So generally speaking, the longer your bond is, the longer your instrument is, the investment, the more interest you have to earn. It's either that, so it's liquidity or safety. Those are the two things that affect, and there's some others, but those are the two main things that affect the interest rate on your investment, okay? Are all government bonds created equal? What are the safest government bonds?
Treasury bonds.
Treasury. Those are guaranteed by the full federal government. They are safer than a state bond or a Lehigh City bond. So just because it's a government bond doesn't make it equally safe. There are some for example, there are some agency bonds out there created by or issued by agencies of the government. Agency bonds are not guaranteed by the government. And so, agency bonds have to pay higher interest than a treasury bond does because of the additional risk. Okay? What is a zero coupon bond? We did mention zero coupon bonds. Zero coupon. What could it mean? What could zero coupon actually mean? Wouldn't it be fun just to take the test today? Could you imagine? Yeah. A zero coupon bond means that there are no payments during the time you hold the bond. It works more like a savings bond, if you remember how the old savings bonds worked with the war bonds. Zero coupon bonds, you would make the investment and it accumulates all the interest and you get paid all the interest and your money back at the end. So, some people invest in zero coupon bonds because they don't want income in the meantime. They want safety. There are some things attractive about zero coupon bonds, but they don't provide income in the meantime. All right. On the last 2 pages of one of the chapters, it talks about long-term investment strategies and short-term investment strategies in the stock market. Who can name a couple of the long-term investment strategies that we talked about? Yes.
Isn't there one where you just buy it and move on to it?
Perfect. Yes, the buy and hold strategy, they call that, shockingly. You buy it and never sell it. Buy and hold. And if you bought the right company, you will be richly rewarded if you wait 20 years, if you buy the right company. Buy and hold is one. Dividend reinvestment is another. And dollar cost averaging is the other long-term investment strategy. Dollar cost averaging means that you buy a stock, a little bit of a stock every month, and you don't care what the price is. You just keep buying it every month, no matter if it's a high or low. And over the years, as you continue to buy this stock, it will average out to a good price for you. You'll buy more when it's lower, and you'll buy a little less when it's higher, and it averages out. What are the short-term investment strategies? Remember, one of them is buying on margin. Remember we talked about buying on margin? Which means you buy additional stock. You can borrow money from the broker to buy twice as much stock as cash that you have. It's pretty risky. It works great if your stock goes up. But it double whammies you if the stock goes down, okay? All right. Let's see. There are two ways to sell a stock. Two types of orders. What are those called? Anybody remember? Maybe I shouldn't keep asking questions, should I? People watching this video will think that I don't have anybody in the audience. Anyway, except for a couple of you. Some of you have answered. There are two. The major kind, the most commonly used kind, is called the market order. A market order is one where you just say, sell my stock at the market price. And it will sell within 2 seconds. It'll be gone. And it might, you might lose a couple of pennies on it, whatever. But if you're not worried about a couple of cents here or there, that's the way most people sell and buy stock, market orders. There's another thing called a limit order or a stop order. Okay? A stop order is one that says, I sell my company stock if it hits $47. Right now the stock is selling at 50 bucks. And I put in a stop order, meaning I stop my losses, is what it means. If the stock starts to drop and I'm in a movie theater somewhere and I don't know, I'm not watching the stock market, automatically sell my stock if it crosses $47. That's called a stop order. And a lot of investors use stop orders. They buy a stock and then they put in a stop order below where the stock is selling so that they automatically can get out of the market if something turns bad. I mean, I don't know what's happening in the stock market today. What if it's crashing 900 points because of an explosion or something? Well, a stop order would get me out of my positions. So some people use what's called a trailing stop. So as the price of the stock goes up, the stop order goes up, trailing behind the current price. Anyway, lots of strategies using stop orders, okay? Let's see. What are the three major exchanges, stock market exchanges, where stock is traded?
New York
Exchange.
New York Stock Exchange,
NASDAQ.
the NASDAQ, and the American Stock Exchange. I'm just going to tell you that the vast majority of what we call over-the-counter stocks are traded on the NASDAQ. Over-the-counter stocks. Okay? Let's see. How do you mathematically calculate the total return on a stock purchase or investment? Let's say the total return on an investment. How do we calculate that?
Annual return divided by current market value or something like that.
Hey, that's interesting. That's close. That's good. It's your current return, which means your dividend income, plus your capital gain. Meaning, I buy a stock for $20. 2 years later, I sell it for $30. My capital gain is $10 per share. That's my profit, to use the word. And that, but also I've received any return on my investment, my current return, which is my dividends. I received $10 per share when I sold it, plus I received dividends while I owned it. So my total return on my investment are both of those things. Current return and capital gain. Okay? Let's see. Name some financial magazines. Well, you've got Money Magazine, you've got Smart Money Magazine, and you've got Barron's. Barron's is a magazine that comes out once a week on Saturday mornings, and all it talks about, you can buy them in the grocery stores, and all it talks about is the stock market. Okay, Then you have also two magazines, newspapers, I mean, Wall Street Journal, which you've heard of probably, and Investors Business Daily. Those are two daily newspapers that come out about the stock market. All right, so what do we call Walmart stock? General Motors stock? AT&T stock?
Blue chips.
Blue chip. Because they're very big, very old, very stable. Blue chip. There is a question on the test about preferred stock. We didn't talk too much about preferred stock, but I will tell you preferred stock has a feature about it. Most people, when they buy and sell stock, they buy what we call common stock. Preferred stock is...
That's when you get into the dividends before the people with common stock.
Okay. Hey, yes. Yeah, he's right. It's good. What we call that is the participation feature of preferred stock. Says that preferred stockholders get a piece of the profits separate from the dividends. Yeah. Okay? All right. What do we call the place, the physical place that brokers go to buy and sell stock? Well, that's very specific, but where's the pit located?
Wall Street.
This is called the exchange. That's how you do. The exchange is where brokers go to buy and sell stock. The exchange, or the securities exchange. Okay, that's what the New York Stock is. That's where the pits are, and that's what the NASDAQ and the American Stock Exchange are. Okay. And what is the purpose of the S&P 500? First of all, what is it?
The top 500 companies.
It's an average, isn't it? So the purpose of it is to give a snapshot of the company. It's to give a statistical average. Remember this, when we say the market is up today or the market is down today, what we're talking about are the averages. We're not talking about every single stock. Even if the market goes up today 500 points, there will be a lot of stocks that lose money. That's just the way it is. But the averages, and what are the major averages?
Dow Jones.
Dow Jones Industrial Average, the Dow. That's the one that's crossed over 13,000 now for the first time in 4 or 5 years. We're hitting new highs in the market for the last, however, remember, 5 years ago, the Dow was higher than it is today. So if you invested 5 years ago, you still will not have gotten all your money back. You'll still have a loss for the last 5 years. But it's a lot better than it was 2 years ago. It's good. The market has done very well in the last 2 years coming back, but it has another 1,000 points to go before it gets to an all-time high. We are not at an all-time high. We're only at a high for the last 4 years. Okay? That's the Dow, 13,000. What's another average that we always talk about? The S&P 500. And the third most common is the NASDAQ average. Those are the three that you'll see quoted on every page, on every internet page you open up relating to finance, like Yahoo Finance or CNN Money. You will see those three averages listed. There are others that a lot of other people use for different things, but those are the three major ones. Okay?
What was the last one?
The NASDAQ average, NASDAQ, S&P 500, and the Dow are the three big ones. How many stocks does the Dow follow? 30. 30 companies out of over 9,000. And yet, it has proven to be rather consistent in representing the market pretty well. But a lot of people now have switched. The Dow was the main one for 100 years. These days, in the last 15 years or so, I think the S&P 500 has become maybe a little more prevalent. All right. If you're collecting items, You're collecting, lighters. What are you going to use, probably, what would be a great way to add to your collection? Yeah, I guess. That's a rather short-sighted way to do it.
eBay.
Most people use the internet. The internet has been incredible for people who are collectors because you now have access to items from all over the world made available. Yeah, it's pretty amazing. Let's see. What are the 4 or the 3 C's of diamonds and precious gems? What do they look for? Good. Carat is one.
Cut.
Cut.
Color.
Clarity. Good. And what's the other C? Color.
I know it, color.
There's 4 C's.
Okay. What's that?
There's 4 C's.
There are actually 4 C's. The cut is not considered a, well, actually it is. I should, let's call it the 4 C's. You've got carat, that's the size. You've got color. And then on diamonds, for example, you've got the yellow, you got blue, you got that, and these all kind of damage the quality and the value. And you've got clarity. Some of them have a little, what am I saying, opaqueness to it, or something. You want completely clear. I mean, obviously, the best diamond would be perfectly clear with clarity, perfect color, which is no color at all, perfect carat size, and perfect cut. Cut has a lot to do with it. Cutting a diamond is rather remarkable if you think about it. They take this little tiny thing and they have to cut it on 20 sides or 40 sides, depending on what shape they're making it in. And if they mess it up, there goes a $6,000 item. Pretty amazing. Anyway, those are the. How about this? Remember the chart that we just saw last time about gold prices? What was the price of gold from 1980 to 2005? What was the price of gold? Anybody remember the chart that we talked about and we looked at? It was about $400, just over $400 an ounce. And for 25 years, that's exactly where it stayed. It's just floating right around $400 an ounce. Now, what's the price of gold? $1,700. So in the last 4 years, or 5 years, gold has skyrocketed because of all the recession problems, and we talked about that. But gold for many years was right around $400 an ounce. Okay? Let's see. What are the problems with buying real estate? We talked about this last time. What are the disadvantages of a real estate investment?
It's active.
It's an active investment. You're going to participate in the management. If you're going to participate. You can make investments in real estate and not be actively involved. You can buy real estate in India. I don't know, maybe you can, I don't know, I bet you can. And of course you're going to have somebody else manage it. But it's normally active. What else?
Liquidity.
Go ahead. Liquidity is a good one. That's what you're going to say? Okay. Liquidity is a negative. And the third one is that it's hard, very hard to become diversified in real estate. Real estate, when you take all your money and buy a property because of how expensive it is, then you have one property on one street in one location. And if you have a problem in that location, then it can hurt the value of your investment. Okay? All right. There are other ways to invest in real estate where you do get diversity. You can buy a REIT, or get into a syndicate or a limited partnership, or buy stock in a company that buys real estate. I have an investment in a REIT that owns not hotels, but hospitals all throughout the United States. They own like 100 hospitals. That gives me diversification. At least location-wise, it does. Okay? All right. Just be aware that there are participation certificates that are issued by government agencies. Government agencies issue what we call participation certificates.
Participation.
Certificates are issued by government agencies. Let's see. What can hurt your real estate investment? terms of the value of it? Well, why are real estate investments 30% lower than they were 4 years ago? What has caused that to happen? Economic conditions. Economic conditions, sure. Okay, very good. Do you remember the difference between an indirect and a direct real estate investment? A direct real estate investment is where you buy property. An indirect investment is where you invest in a company that buys property. So I'll give you an example. If you buy a mortgage, if you buy a debt of somebody else's, have you bought a property? The answer is no. You haven't bought any property. You bought a note. You bought a mortgage. That's an indirect investment because you didn't take ownership of the company, of the property. Okay? Let's see. Apartment house. What kind of property is that called in real estate? In real estate, buildings have generally two broad categories. Either they are residential property, like houses, or they are commercial property. Be aware that big apartment houses are considered commercial property. Okay? Because you're not going to live in them. So they're commercial property. What is the largest financial asset? Hey guys, there are some of you that aren't focusing at all. Here's what's going to happen. I promise you. You're going to do worse on the second half of the test than on the first half if you don't continue focusing. It's kind of I can start at the beginning. If I start at the end of the test and I work my way forward, you'll do worse on the first half of the test. I've done that. I've tested it. So give me the last 10 minutes and I think you'll do better on the test. Some of you are doing other things because you think other things are more important, but focus on this review, please, for your sake. All right, what is the single biggest asset for most Americans? Their home. Their home is by far their biggest single asset. Let's see. Oh boy. What did I tell you as well? I'll just tell you. One of the negatives of mutual funds that I mentioned when we talked about it is the idea that when a mutual fund buys and sells stock inside the mutual fund, even though you don't sell the mutual fund, it affects you tax-wise. The changes in a mutual fund get passed on to you as the owner of the mutual fund. And so if you own Kane's Mutual Fund and I sell Microsoft stock for a big profit, at the end of the year I send you information showing that you owe money, you owe taxes on a part of that profit because you own the mutual fund. Even though you didn't sell your mutual fund, you might have to pay taxes as you go along. That's one of the negatives of mutual fund. That's called capital gain distributions. We distribute the capital gains to the owners of the mutual fund. Okay? Now the good news is when you sell your mutual fund 5 years from now, you don't have to pay taxes on that gain you already paid taxes on. But you kind of pay your taxes as you go. Rather than with stock, you don't pay any taxes on stock until you actually sell the stock. Okay? Let's see. Oh, brother, what a stupid question that is. There are two types of mutual funds, open-ended and closed-ended mutual funds. Closed-ended mutual funds do not allow any more investors, meaning they're not providing more shares. Now they're not taking any new investors. Now, that doesn't mean you can't buy them, but you have to buy shares in the mutual fund, and they operate like stock. Whereas an open-ended mutual fund, you can send them $100 a month and they will buy as many shares as that offers or provides you. Does that make sense? Yeah. So in the book, read about closed-ended and open-ended mutual funds. What is the single biggest advantage of a mutual fund?
Diversification.
Diversification. It provides instant diversification. That's correct. All right. You can buy mortgages, you can buy notes, you can also buy a pool, like a mutual fund, if you will, of mortgages. So you can put your money in and you will own a piece of 10,000 mortgages. That is called a participation certificate issued by a government agency. And that offers diversification. Rather than putting all your money in one mortgage, you put your money spread evenly across. Now, you will not get as good interest because of the safety. It's much safer. And so you will have to pay a price with interest rate. But let's see. What do we call an emerald or a diamond or a ruby?
Precious gem.
Precious gems. That's right. All right. Let's see. Name 3 agencies that sell participation certificates. Fannie Mae, Freddie Mac, and Ginnie Mae. These are government agencies that specialize in pooling mortgages together and selling them. Freddie Mac, Ginnie Mae, Fannie Mae. Sounds like a bunch of hillbillies, doesn't it? Having a hootenanny.
Freddie, Ginny, and
Fannie, Freddie, and Mac. We call those. Freddie Mac, Fannie. Oh, gee, now I'm all confused. Ginnie Mae. Freddie Mae. Freddie Mac, and Fannie Mae. Wow, hey, Fannie Mae, Freddie Mac. Oh, come on, leave me alone. Anyway, let's see.
What are those?
Those are government agencies that pool mortgages together and sell participation certificates, so that you can participate in that pool of mortgages. All right, let's see. Another word that they use, just so you know, for treasury notes and bonds that are guaranteed by the entire government are called general obligation bonds. General obligation bonds obligate the entire government. Okay? Let's see. Walmart makes $5 billion last year. They send out $3 billion to the owners of the company. What do we call that? Stockholders. The money they send out are called dividends. But they keep $2 billion in profit to grow the company. They don't send out 100% of the profits. What do we call the money they keep in the company? We call that retained earnings. Those are earnings that are retained by the company for their future growth. It is not healthy for a company to pass out all their profit. We don't want them to do that. In fact, I won't invest in a company that pays out more than 60% of their profit. I don't want them to. It's not healthy. So if they'll pay, I like 30 and 40% is what I like. That means they have room to grow. Anyway, okay. Let's see. If you receive income and it will be taxed later, at a later date, what do we call that kind of income?
Tax deferred.
Tax deferred. That's what it's called, tax deferred income. What's the best kind of income? Tax exempt income would be the best, yeah. That never gets taxed. Let's see. If I read this definition to you, a company's written pledge to repay a specified amount of money along with interest. That's called a bond. That is a bond. A written pledge to pay back a debt, okay, is a bond. Let's see. If I take a dividend, okay, here's the deal. I buy Disney stock. Disney stock, anybody know how much Disney is selling for? Anybody buy Disney in your portfolios? How much was it?
Like 50,
$50? Okay, so you buy Disney for $50 a share. And let's just pretend it's paying out, let's say it's just round numbers, let's say it's paying out $5 in dividends. What is the current, what is that called? If you calculate how much you're receiving in dividends based on your investment. You divide the dividend, you divide the dividend by the stock price. So you take a $5 dividend and you divide it by the stock price of $50. What am I earning? How much am I earning? 10%. What is that called? That is called the current yield on the investment. The current yield is a 10% return. Now that would be a very high return. Disney does not pay that high of a dividend. Very few companies pay 10% dividends. But that's called the current yield. And that's the end of the review. 50 questions. I'm telling you right now, this is not the easiest test I give. The scores on this test generally are a little lower than on the other tests because of how picky some of the questions are. So do me a favor, take this review information, combine it with some time in the textbook, looking over the vocabulary words. I also on my website have an additional review that I did last year. It's not video, it's audio, but it talks about the same questions, but it talks about them a little bit differently, and the combination would be powerful. If you could take the time to listen to that, it will help you. When is the test?
Monday.
On Monday.